Good afternoon, ladies and gentlemen. Welcome to this webinar this afternoon, hosted by HVS, Bird & Bird, AlixPartners and EP, working in partnership to look at the global performance of hotels over the past year and place some forecasts on what's likely to come and to be expected. It was JFK who once said the Chinese used two brushstrokes to write the word crisis. One brushstroke stands for danger and the other for opportunity. In a crisis, always be aware of the danger, but recognize the opportunity. So we will try to learn today about what opportunities exist and what dangers are obviously still lurking there. There's also a quote from the 2008 financial crisis, which says sometimes the aftermath is far more devastating than the storm. That was the story of 2008 financial crisis. It was disastrous at the time, but what was worse was often the lingering effects that remained after. Do we still face the worst of what the fallout from the pandemic? I think we're going to try and find out today exactly what we're going to look at over the next year. The last year has changed much. Many have reforecast not just once or twice, but 3 or 4 times. It's kind of tested every leader in every possible way. Many feel they've learned more in the last decade, in the last year, than in the last 10 years. However, if the hardest is yet to come, what are we going to face? How has the downturn compared to previous crises? Which markets possess the opportunity we touched on a few seconds ago, and which ones are very vulnerable? What are the trigger points to benchmark the revival? Over the next 1.5 hours, we will see some excellent insights from the various speakers on what the future may hold and the challenges to be faced. It will be thought-provoking and inspiring, so I do hope you enjoy the session. And thank you again for joining us. Lauren, can I bring you in just to touch on the polls?
Absolutely. Thank you, Chris, and welcome everybody. It's always very helpful for us to get a bit of insight into your thinking, and to do this, we launch a few polls before we start. The first one I would love you to have a look at is this: having coped with COVID for the past year, when do you think that hotel RevPAR in your part of the world will be back to 2019 levels? Do you think it's 2022, 2023, 2024, 25 or later, or hopefully not never? Okay, wow, that's interesting. Seems that 2024 is definitely the majority answer on that one. The second poll that I have is around the region of the world that the hotel RevPAR recovery will be the fastest on average. Now, do you think that's going to be in Europe, in the Middle East, Africa, North America, South America, or Asia Pacific? Gosh. Again, very interesting. It seems that most of you believe that Asia Pacific is going to be ahead.
By a long way.
Yes, gosh, absolutely. The third poll question is: in which region of the world will hotel transaction volumes, and that would be both for distressed and non-distressed, recover the fastest on average? Do you think that's going to be in the UK? Is that continental Europe, the Middle East, Africa, North America, South America, or Asia Pacific? Well, that is a different outcome there. It seems that you believe that that could very close between North America and continental Europe. And my final question is as follows: do you think that governments should introduce what they're calling a green passport for those who have been vaccinated in order to stimulate travel? And I totally agree with that. 80% of you say absolutely we should be looking at the green passport. Thank you so much for participating in that. We really do appreciate it.
Now, we do have a question and answer button at the bottom, so please do feel free to ask questions as we go. Now, I can't say everyone's going to get back exactly on the spot, but we will certainly try and answer every question posed, either during the session or afterwards, if possible. possible as well. So please do feel free to ask any question you so wish within reason. Now, can I please welcome David Eisen, from the Director of Hotel Intelligence Americas for HotStats, to the screen. HotStats, for those who don't know, is a global profit and loss data benchmarking company. And prior to HotStats, David served as editor-in-chief for the Questec Hospitality Group, which included Hotel Management Magazine. David, a warm welcome to you today.
Fantastic. Well, thank you, Chris. Thank you, Lauren, and thank you, HVS and Bird for having me this morning. This morning, I'm here located in Washington, D.C. in the States. It's interesting to see those polling questions. We've been conditioned here in the U.S. not to always trust polling, especially when it relates to politics, but hopefully some of that stuff will all come true. So what I'm going to do is run you through a review of some numbers and pertinent KPIs. I'm going to go ahead and share my screen. And hopefully everyone out there virtually can see my screen now. I'm going to start off with a little bit of what we call a meme. I'm sure you all know what memes are, how it started, how it's going. So apologies for not making a football or soccer reference. What you're seeing in front of you is actually a March 11th basketball game in the National Basketball Association between the Oklahoma City Thunder and the Utah Jazz. And you can see people are together, no mask, grouped together. This is on March 11th. And as you can see, people are filing out of the stadium of the arena because the game was actually canceled. So this is all how it started. This is March 11th, the same day that the WHO actually declared COVID-19 a pandemic. How it's going? Here's the case counts. As you can see, globally, 123.5 million cases of COVID-19. We're here in the U.S. We're leading everyone with 29.8 million cases, 2 times more than our closest competitor, which would be Brazil. UK around 4.3 million cases. And China, only 101,000 cases, but you might want to take that with a grain of salt. So what I'm going to do now is run you through some numbers, as I said before. Obviously, I only have a few minutes, so I'm going to try to keep my speaking as brief as possible. What you're seeing first here are some headline numbers, some key regional KPIs. These are in U.S. currency. You can see RevPAR, TRevPAR, and GoPAR, all color-coded. So for brevity's sake, I'm actually going to focus on profit. And obviously you can see the attenuation of all the numbers in 2020 versus 2019, which would be on your left side, on the right side, 2020. So for the US, you can see GoPAR is down 93.9% year over year to $6.13. And I'm sorry to say that in Europe, it was even worse. GoPAR down 101.5% year over year into negative territory at negative $1.11. The story, as you'll see as I go through, APAC and the Middle East doing quite better. Obviously still down year over year, but APAC GoPAR was down 77% year over year to $13.43. Middle East GoPAR down 77% year over year to $15.82. So really the takeaway from this slide is the Middle East and APAC regions have fared better than the US and Europe from the start of the pandemic and up through to now. As we're a monthly data company, so we have monthly data rolling. So I wanted to show you some of our most recent data, and this is really looking at January 2021 versus January 21. January 20, again, the same regional KPIs, but this is how it stands right now. Obviously, 2021 not off to an auspicious start based on the January data. Again, you can see these wide margins to the KPIs. As you can see, the negative GoPAR in the US and Europe, as further lockdowns took and are taking hold as a third wave of the pandemic sweeps across Europe. Germany will likely institute a new lockdown, obviously lockdowns in a third of France, and even in the US, speaking with a colleague earlier, we were in places like South Beach and Miami. They've recently instituted an 8 p.m. curfew, which if you've ever been to Miami is very, very early. Nothing gets started there until way later in the night. A recent study said that a year of COVID lockdowns has cost the UK economy some 251 billion pounds. And as you can see the Middle East is a bit more resilient. APAC showing a little bit of regression off 2020 numbers. This next slide, which I call the profit parable, the lessons learned. Obviously, many lines here. So, but what you're seeing is the monthly year-over-year GoPAR percentage change. This gives a really, I think, good idea of the profit story. We saw China drop off the cliff first in February, followed by dips in Europe, the US, and the Middle East. which saw an even more sustained drop off. But really, you can see, if you can follow these kind of dotted lines, chopped up a little bit, but you can see from the lines that almost as V-shaped and U-shaped recoveries in China and the Middle East, as Europe and the US continue to flatline, if not regress. So really the takeaway here again is, while it looks like the rest of the world is really chasing Asia and the Middle East, which are climbing closer to back to pre-pandemic levels on a profit continuum. Getting into looking at asset types, obviously all asset types are not created equal. And what you're seeing here is asset class in Europe by occupancy. Europe and US actually have really quite reacted quite similarly as it along asset class. What we've seen, the occupancy data shows that the economy and extended stay segments have really performed better during crises. Obviously, like the pandemic, we saw this back in after 9/11, also after the Great Recession too. For the former economy, extended stay, a reliance on longer term stays. Some regulations actually here in the States have helped extended stay hotels during the height of the pandemic. For example, some US states put a moratorium on short-term rentals, popular with the likes of Airbnb, which meant more demand for extended stay lodging. Extended stay also benefited from healthcare workers needing lodging, students at universities, and especially leisure travel. Families seeking out drive-to destinations with amenities such as larger living spaces and kitchens, so they wouldn't necessarily have to go out to eat. There was even a weekend demand pop from business travelers who elected to stay the weekend as opposed to flying home and having to come back the week after. Again, looking at asset classes by profit, again, this is in Europe. Similar story, but you can see the huge drop in the luxury hotel space, which have struggled mightily during the pandemic due to many factors, including a higher fixed cost base and reliance on ancillary revenue. Similar with full service hotels that have lost meetings and conference business. I guess maybe on the bright side, luxury hotels do tend to founder the most during a crisis, but they also tend to rebound much more quickly, which is something we saw again after the Great Recession. Looking at the impact on segmentation, so looking at, again, and this is for Asia Pacific by occupancy, looking at bar business, corporate, leisure, conference, and tour groups. Obviously, you can see the drop off in leisure leading the comeback as domestic travel resumes. Interesting to see that pop in conference business, obviously, until people feel more comfortable meeting in person. We will continue to be living in this virtual world and being zoomed out. I'm sure you can all agree that Zoom fatigue is a real thing. I actually had anecdotally a June in-person conference that just yesterday was changed to a virtual conference last week. Obviously, the question is, when will large companies get their employees back on the road? Things like liability all coming into question. But you can see obviously the pernicious impact the pandemic has had on segmentation. Impact on segmentation, again, looking at Europe by occupancy, further muted trends here. Corporate continues to drag along the bottom. Ominously, a recent report from McKinsey said that 20% of business travel won't come back, and about 20% of workers could end up working from home indefinitely. As someone who has WFH, as they call it, work from home for the past year, I will actually disagree with that, and I'm more optimistic. Looking at some departmental revenue, obviously as demand dried up, ancillary revenue followed as well. You can see these large year-over-year decreases in F&B, in spa, in leisure. Again, we're looking at food, beverage, conference and banqueting, spa and leisure, and other along in Europe, the US, APAC, and the Middle East. You can see the large year-over-year decreases again throughout. In discussion, though, I would say with many owners and operators, we could see long-term changes in F&B structures, especially on the cost side. Removing or paring down the buffet, for instance, taking out hot items is one thing that many owners I know have done. And the phasing out of the traditional 3-meal restaurant as customer tastes shift to grab and go and packaged items as well. Getting into some payroll, I know obviously this is your biggest cost on the your biggest cost for hotels. I even spelled labor this time with a U. It's paying me to do that as an American, but obviously with the European UK crowd out there, labor with a U. But we're looking at labor costs per available room, and as you can see the regression and regression in labor costs. First in December 2019, then in April 2020 at the height of the pandemic, and then in December 2020 along China, UAE Europe, and then some other regions under Europe as well. Europe and US has not moved much since April. The big takeaway is that China is getting closer to prior year levels, and the cost of labor in the UAE, the Netherlands, is high to begin with. I will have to investigate these Dutch numbers further. Maybe someone would have a better idea why it costs so much for labor in the Netherlands. Efficiencies on the labor side in the US, housekeeping moving from daily expectation to on demand, slimming down of F&B, as I mentioned before. We also have a real phenomenon of a dearth in talent as displaced employees are moving to other industries, but also, and this is purely anecdotally, many rather staying on unemployment in the US, boosted with the federal government boost on top of the normal unemployment. Getting into some undistributed labor trend, these are mostly fixed costs within A&G, sales and marketing, property and maintenance, information and telecommunications. And as you can see, we're seeing this gradual uptick in the UAE and China, and then a continued flatness in Europe. What's overhead? So looking at some total overhead costs on a per available room basis, again, is in US dollars. So this is accounting for everything except for direct labor, direct materials, and direct expenses. So if your accounting fees, advertising, insurance, interest, legal fees, rent, repairs, supplies, travel expenditures, and utilities. It's the same type of story that we're seeing previously. These large dips in the UAE, China, and Europe at the early part of the pandemic, the gradual uptick, but larger in the UAE. Looking at some operating costs, they're really recalibrating. We're seeing in the Europe, and we're looking at these are European data. We use per occupied room to calculate this because most of these costs are variable in nature. You can see this kind of initial huge sharp jump in April in operating costs is COVID-related measures, but COVID-related measures have been offset by operational efficiencies, as you can see, kind of moving out from April. Anecdotally, one hotel owner told me that in the wake of the pandemic, his water bill was up more than 40% year over year because they were washing more linens, et cetera, due to the COVID protocols. And that's why you saw that kind of sharp jump in April. And obviously that's come down since then. As an aside on the fixed cost side, host hotels and resorts I was speaking with the other day, they're a huge real estate investment trust here in the US. They told me that their fixed costs were down 50% actually year over year. Another owner stated similarly that his fixed costs had actually become variable in nature, and he was seeing things come down in areas such as workers' comp insurance and property taxes as well. So elsewhere, we've seen workers' comp insurance actually rise as companies typically require premiums to be paid up front at the start of each year, and obviously this impacts cash flow. So in summary, US and Europe hotels are playing catch up with Asia and the Middle East. Extended stay and economy properties have performed better than full service and luxury hotels throughout the crisis. Initial direct operating cost increases seem to be rebalanced. Payroll will be the defining cost line moving forward and how it is handled. Early evidence showing hotels reopening leaner than prior to the crisis. Hoteliers rosy about the future of industry, obviously on the back of vaccine acceleration. I myself am very rosy on the future of the industry as well. I think we'll get back to pre-pandemic levels quicker than I think many prognosticators are making, not procrastinators, excuse me, on the back of vaccines. So with that, that's the end of my my review. Thank you all for listening. And Chris, I will throw it back to you.
David, thank you. That was excellent. Really interesting indeed. Now, quickly remind, just to let you know, all slides will be circulated after this event. So please don't feel you have to take all notes and everything. We will be circulating slides. Now to Russell. May I introduce Russell Kett, the chairman of HVS. Real pleasure. Russell, good luck. Hope it will go.
Thank you very much indeed. It's now my pleasure to share my screen, and hopefully the technology will work. And what you're looking at instead of my smiling face is what looks like the first of a very impressive deck of slides, which, as Chris says, we'll be happy to send out afterwards. So I'm going to follow on from where David left off and have a little bit more forward looking and where we feel the hotel industry in Europe is heading. So I'll cover this agenda. I too have got 10 minutes. So like David, I'm going to be taking this at a hell of a canter, but hopefully anything which you're interested in will be picked up by the panel afterwards, and we can talk about it. But a little bit on what I'm calling an unprecedented downturn before looking ahead, talking a bit about hotel values, and then reaching some conclusions. So what do we mean by an unprecedented downturn? Well, there in one slide is partly what David was talking about and partly what you've been watching for the past 12 months as to how the position in European hotels has unfolded. The red line of 2019, the blue line of 2020, altogether a pretty sorry state which we've witnessed, and it hasn't really got any better at all as we've moved into 2021. But on the slightly good news side of the coin, RevPAR recovery has tended to average 6 years in previous downturns. So we had 9/11, the impact of that, we were back to RevPAR within 6 years. Global financial crisis, or the Great Recession, as the Americans like to call it, of 2009, 2008, 9, whatever, again, a 6-year recovery. And it was quite encouraging that when we did the poll at the beginning, that most of you feel that RevPAR will be back by 2024. So looking ahead, there are going to be some winners and losers, and we've probably already worked out who are the more vulnerable hotels and which are the less vulnerable hotels. And it's quite clear that luxury hotels and gateways and those that are in fly-to markets and airport hotels, unless you're dealing with people who are being in quarantine, you're not doing perhaps as well as you might. And those that are suffering less include extended stay hotels, apart hotels, service departments, and so forth, as we were hearing before. Those that you can drive to, and so forth, and economy and mid-scale properties, as David pointed out. So the gateway and primary markets have yet to see an uptick, but they will happen, and it will happen. So what is going to revive hotel demand? We already saw the impact of staycations last summer. And as we work through 2021 towards that magic 2024 that we're all agreed, or most of us are agreed, is when we will see that recovery. You've got a whole number of factors: vaccinations, the return of air travel, corporate travel getting back, MICE business eventually returning, and so forth. So to that extent, I feel that we're in for some interesting times, and it's a dotted line because nobody can be that certain, but I'm pretty confident, like the rest of you, that by 2024 we will have really come back to where we started out in 2019. And putting my money where my mouth is for a moment, that is a picture of the historical development, 18, 19, 20, and our forecasts for 21, 22, 23, 24. You'll see occupancy almost back in 23, fully back 24, an average room rate back to where it was previously by 24 as well. And from our perspective, whilst the first half of 2021 isn't particularly exciting, I feel quite confident that everything will really start to come together in the second half of this year, and that we will then achieve that overall 6-year timescale to recover. I thought it might be interesting to share with you what my colleagues around the world are projecting. Here is a slide that shows when we feel occupancy is going to be back to where it was in 2019, and GCC ME is Middle East, for those who don't know the acronym. The rest of it's pretty obvious, but you can see most feel that occupancy will be back somewhere between 22 and 23, a little bit more happening in 24. And in terms of RevPAR, shown this slightly differently, back to where we were in 2019, effectively where we crossed that one line, that's where we feel. So some countries moving slightly faster, Asia, as was mentioned previously. So that's where we feel we're going to be back globally. For those of you who kindly joined us from right around the world, we've got people from the most faraway places today. We do expect, coming back to Europe, but I think this comment applies anywhere in the world, supply growth is going to be slower. Some new hotels are just going to be cancelled altogether. Some are going to be placed on hold. Some properties that have closed are never going to reopen. Some are going to need to be repurposed. But either way, supply growth is going to be slower. And we also, like was discussed by David, we think that there is going to be some enhanced operating efficiency, some positive leverage from the operations, and that's going to help support the recovery of EBITDA at the end of the day. I'm not going to go through the details of these. A, you can read them for yourself, and B, David has mentioned some of them already. But what's clearly happening is that operators are getting used to being able to operate profitably at lower levels of occupancy. And I think that that is going to be something that we will see continuing once we get back to a so-called sense of normal. Bit on hotel values now, if I may. We did see a drop in hotel values, as you can well imagine, in 2020. Driven by the loss of income. It's not surprising when you're closed that your income goes to zero and your profitability possibly goes to even -0. The debt markets have pulled back. And of course, anything that was being offered for sale, the bid-ask gap between buyers' expectations and sellers' hopes was just too big to make a difference. But it did show that there is a lot of interest whenever anything does come to the market. And there are different pressures that are affecting the prices at which hotels are changing hands. You've got some downward pressures. These are pushing the prices down, whether it's the fact that revenue and EBITDA has declined on an unprecedented basis, the fact that MICE business will take longer to come back, the fact that there will be a prolonged recovery and cash drains may force owners to sell. But you've got the potential of an improved business model. You've got positive operating leverage returning. Lots of people with lots of money lining up their capital, helping to create competition and helping to sustain values. And the fact that the low cost of capital is likely to continue. So on the one hand, you've got some things which are pushing the price down, but others helping to keep the prices up. And I thought I'd share this with you, which is an actual result of 130 hotels that we valued both in 2019 and in 2020. Out of the 300 or so that we did in London last year, 130 were actually hotels that we'd valued previously. And this summarizes the change in value year on year. Not many, it has to be said, were able to show an increase in value. Most of them were in negative territory, but somewhat pleasingly, most of the hotels that we valued, the fall was between -5 and -15% of their previous value. And I promise you that this is an actual table. It wasn't something that we created in advance and said we need to make sure that our values lie within this region. This is an actual result which I think shows, at least statistically, that most hotels, as you can see here, didn't drop off a cliff in terms of their values between 2019 and 2020. And here on a global basis, this is where we expect values to return to previous levels in 2019. So again, where you see those lines crossing the 1 horizontal bar, that's getting back to 2019 levels. And we see that most will get there by 24, 25. Just a quick word on transactions. You can see from this graph that they basically fell off a cliff in 2020. There was a huge decline, something like 70% over where it was in the previous year. Hardly surprising, I'm sure, but that still in 2020 remained well above the low that we achieved in 2009. As I mentioned before, there's been significant equity raised to invest in hotel assets. And what's happening is that the competition for anything that is available is limiting the discounts in pricing from the pre-COVID levels. Debt markets closed down, but have opened up to hospitality again in a limited sense. And I'm sure Tim Helliwell in the panel session will confirm, but it's mainly through private debt funds, not through the main sources of senior debt. So that's where transactions were at last year. And just to bring everything to a conclusion and then to hand over to our panel, obviously RevPAR levels depressed and they will start to recover once travel limitations are lifted. People are comfortable with traveling again and staying in hotels. And of course, the vaccine is going to help materially. We do think that occupancy will recover a little bit faster than average rate, and supply growth at the same time is going to slow down, which will certainly help the production of occupancy levels and so forth. There has been obviously a suspension of hotel operations. Many hotels have closed, but obviously that helps to minimize the EBITDA losses where possible, added to the government support that's been available. As we've shown, hotel values declined in 2020, and that once there is evidence of recovery and the EBITDAs have moved upwards, we think that that will lift the depression on values and we'll start to see a return. Hotel discount rates elevated in the short term, but that will change over time. The weight of capital might limit price discounting for some hotel assets. But what we found is that most specialist hotel investors haven't changed their investment strategy. They're still interested in hotels if they become available. So we think over the longer term, hotel values will recover as cash flow improves, markets return to their more traditional parameters, and that there will still be an opportunity for high returns where there's well-capitalized buyers acquiring hotels at prices that are definitely going to be below replacement cost and recent norms in some cases. And we hope that that will be soon. So that's my glass half full moment. And without further ado, I'm more than happy to hand you back to Karen Freeb, who's going to be taking us through the panel session and will very nicely and kindly introduce her panel. Over to you, Karen.
Thank you very much, Russell. It's always great to start on a glass half full moment. Let's hope our panelists can maintain that sentiment. So if the panel could kindly come on screen and unmute, I'd be very grateful, and I will introduce you all. I'd like to start with Asli Kutlukan, who's the Chief Development Officer at SICAS Hospitality. Asli is a hotel development professional who has worked in global hospitality for over 25 years across the USA, the EU, Africa, and Turkey. We then have Simon Vincent, who's the Executive Vice President and the President for Europe, the Middle East, and Africa for Hilton. Simon's based in London and is responsible for an unbelievable 562 operating hotels and a further 368 in the development pipeline. And that's across 13 brands and nearly 70 countries and territories. Simon also sits on Hilton's Global Exec Committee. Tim Helliwell heads the Barclays Hotels team with responsibility for their hotel clients across the UK and Europe. Tim has financed the hospitality sector for nearly 20 years and now focuses on ensuring that the bank maintains a cohesive approach to the marketplace in terms of its funding strategies and long-term relationships with clients and advisors. Next, we have Jonathan Phallic, who's the founder and chief executive of JF Capital Advisors. Jonathan is based in New York City, although I'm loath to tell you that he's currently sitting in Miami Beach. And he also has over 25 years in the real estate and lodging sector. Jonathan leads the firm's hospitality business, which includes equity and debt placement, asset acquisitions and dispositions, and asset management. Next, we have Jan Hazelton, VP Global Business and Real Estate Development at Kersner International. Jan's a seasoned hotel investment and development executive, and her experience includes banking, asset management, finance development, feasibility, and investment analysis. And last of our panelists, we have Graham Smith, who'll be known to many of you, who's the Managing Director and Co-Head of Financial Advisory Services at AlixPartners. Graham also has an awesome 2 decades of UK and cross-border experience in advising clients on matters such as buy and sell side M&A, raising or refinancing of equity and debt, valuation matters, and financial restructurings. And I'd like to warmly welcome the panel. And just before we start our questions to the panel today, I did a quick tally up while Russell was speaking of all those decades of experience, and was quite overwhelmed to see that between them, our panelists have, I think, over 130 years experience. So I think we're in for some really great comments today. So let's get cracking. And I'd like to start with Simon. So Simon, really to pick up on this theme of global trends, what do you think that we can learn from the recovery trajectory in China, Americas, and the Middle East? So that's really in terms of market segment, guest profile, and growth.
Thank you, Karen. Good afternoon, everybody. Great pleasure to be here. Listen, I think the one thing we can learn is that this is going to continue to be unpredictable. I think it's very difficult to see a straight line recovery in all of the markets, in all of the countries and all of the segments that we're operating in. And I think if you look back over the course of the last 12 months, I mean, we dipped hard and we dipped fast, and the crisis went pretty much from east to west, as both Russell and David have described. And actually our recovery, although it started in China, came through the Middle East and the rest of Asia, or parts of Asia, into the US and continental UK ultimately. It hasn't been a straight line recovery for any of us. And I think what we've seen mirrors a lot of what Russell and David have said. Leisure transient has definitely led that recovery. Resorts and provincial hotels have been busier than city hotels, certainly. The budget and mid-market sector has certainly been busier than the full service sector, but our resorts equally have been busy. Try getting a room in the Seychelles or in the Maldives at the moment and you'll struggle. And I think, we have seen progressive improvement quarter on quarter as we've moved beyond the initial shock and into recovery mode. But I think it has stalled in certain markets. And I think, to come back to my earlier point, I just don't think it will be a straight line in any market. And I think we've all got to adapt and adjust and change our business models to reflect that.
And Simon, how is Hilton approaching what I call shifting customer expectations? So in areas like cleanliness, accelerating tech, environmental and socially responsible tourism, which is becoming every time you look at a bulletin on hotels, we see environmental and social responsibility mentioned more and more.
Yeah, look, I think customer and social trends are such that this is a way of life going forward, and any responsible business will be doubling down on all of this. And look, we were very quick to launch, our clean stay initiatives and our event-ready solutions for our customers. Not surprisingly, most of them were demanding of that. Most corporate accounts now require, a detailed ESG policy, and want to review that and want to know that we are committed to those programs. So I think those are going to be a way of life going forward, and something that we are doubling down on. And I think the digitalization of the customer journey has probably accelerated by 2 to 3 years in the context of this pandemic, where I think we're all reinventing a lot of our hotel operating processes and our customer experience and the customer journey as they go through the whole booking of their holiday, the actual physical stay in the hotel, and ultimately the post-stay correspondence. And that whole journey is being completely engineered, and technology has been integrated into that.
Thank you. Just picking up on that, Ashley, everyone obviously is picking up a lot of learnings from the whole COVID scenario. They're forcing hoteliers to look at more efficient operational standards. Do you think they can maintain leaner operations coupled with this higher usage of accelerated tech that Simon has just been touching on? And are hotels finally learning the seamless operation model that the airlines say had to decades ago?
Absolutely, yes. That's the answer to both questions, but let me dig in slightly on the first part of your question about the lean operation. Now, look, when we established about a decade and a few more years, 12 years ago, Sarkas, to have a unique selling point in the market and coupled with our expertise at extended stay, we always came to market as the extended stay guys originally, and for many things, as I say, because of the experience. And one of the ethos about extended stay is that lean operational model. So as Psych has grown, of course, we became an operator across 5 countries. We became operator of full service, limited service, lifestyle, you name it, all concepts. But one thing we, of course, implemented is that learning from or expertise from our extended stay lean service model and friendly service model, and cross-training between especially the food and beverage and the guest services on the front desk to make them not 2 teams, but 1 team. And of course, this is one of the reasons why we have such a profitable model in extended stay. And we've been running our full service hotels with this model in mind, because we know this, and it's always worked very fine for us. So now we are evaluating a lot of changes in the market, and we are seeing that majority of the hotels that remained open during this COVID period, they had to revert to that model, and they actually were forced to adopt that model. Now that model works very fine, because you have to basically cross-train all your staffing levels, pretty much all customers facing staffing levels, and increase them as your occupancy and your demand increases. It's nothing very difficult. It's just trying to find the right peeps who are willing to learn both skill sets, and which in hospitality they do. So it's I think it's here to stay. Look, there are of course physical advantages and disadvantages of certain buildings. If you have a hotel which has reception on the ground floor and all of its F&B and lobby operations upstairs, this kind of things is going to be a bit more challenging. But yes, I think it's here to stay. Recently I stayed at our the newest hotel, a newest addition to our hotel portfolio in Brussels, the Cubic Brussels. We took the management on that one, and when we arrived at night, all of our food ordering to everything we ordered was via these apps that you can just scan. And we, if we were not the company directors who managing the hotel, we wouldn't have to deal and speak to anyone when we were checking in and ordering our
that's great news for the customer, surely, isn't it? So do you think the world is finally seeing the upside of extended stay hotels generally? I mean, learned from extended stay has been shown by global data, certainly in the EU and the UK, to be outperforming the competition. And of course, we've recently had the announcement that Extended Stay America is to be acquired by the JV between Starwood Capital and Blackstone, which sent the shares in ESA absolutely soaring. So why do you think that is? And is it a trend that's here to stay? I'm sure you'll say yes to that.
Look, again, 12 years ago, I don't know how many teams, company, including, I think we went to every single bank, every single European PE, including the brands, going around preaching about extended stay and how resilient it is in downturns. So I'm not going to repeat that here. Yes, it works. And I will give you some facts to everyone on this program. We have extended stay hotels across the UK and Europe. And last year during the COVID, they all perform break even at GOP, if not profitable, even more. You know, we actually perform this, and our brand partners who we have these properties, of course, knows that fact. And I have STR. I can show you STR reports. My extending stay properties in Liverpool, in London, in Frankfurt have an RGI of almost 500. I mean, that's even when I first seen that, and our revenue team represented that to me, I'm like, you guys joking? Well, why did you manipulate these numbers? But it's the fact. So yes, A, it's here to stay, and B, it's resilient.
That's good. I could see Tim taking notes there as well, avidly. So just moving on to Jan now. Jan, how do you feel that the luxury segment is coping, just moving on from extended stay, and how will it emerge from the pandemic? What do you see as the key advantages and the key challenges for the luxury segment? You know, particularly given one of David's slides showing that the luxury segment tends to perform worst in times in current market.
Yes, thanks, Karen. Well, I would say, first of all, being a luxury hotel owner and operator is either a blessing or a curse. And it's a curse if you're a luxury operator in a big urban center, big city, because they've been hit extremely hard. And that's where I think David's charts reflect those luxury hotels there. However, if you're an urban luxury or a resort luxury operator or owner, it's been a bit of a blessing, because if your customers can get to you, the business has been great. I mean, we've found, we're a resort company, and so all of our hotels, if they've been open and if people can get there and the government allows it, they've done very well. And a lot of them have had to refocus on domestic business, and I think that's a theme across all hotel operations, is that they're really focusing on domestic demand, and the urban hotels suffering, but in unique destinations or resorts have been doing extremely well. And I think some of the luxury segment has been very creative in what they've done. I think, example, the Royal Lancaster in London, they just finished a beautiful renovation and then COVID hit. And so what they did is they then they invested into some virtual reality meeting equipment. And so they were able to then take a ballroom that hasn't been used and actually turned a lot of revenue off of it by having fashion shows, car launches, product launches, where the customers were very excited about it. And it could be either completely virtual or virtual with a limited in-person attendance. And, that's one really creative use of the space. A second is our Atlantis in the Palm. We worked with an artist called Sasha Joffrey, and he took our ballroom, which wasn't going to be used, huge ballroom. And what he did is he took this space and he created an artist gallery for a philanthropic project. And he created the world's largest canvas, which is now in the Guinness Book of Records. And so he's going to be then parceling this up and selling panels to raise money. But it's just a way, and I think a lot of hotels have been creative in that sense, if they have been able to stay open. So
no, well, that's great to hear. And I just wanted to touch on the fact that you've had some recent travels in the United States. And can you let us have your perspective on what's happening over there before we move on to Jonathan to get some real on the ground observations there? What is your feeling about what you've seen there?
Well, I think travel is very different. It's being one of 5 people on an airplane. It's being in a San Francisco air concourse, and you are the only person that you can see in there. It's very depressing. But I think it depends on where you are in the States as to whether, it is very, very, very Democratic or Republican. If it's a red or blue state, you feel the difference when you're there. Either it's very busy or it's not. But also when you check into hotels, I stayed in a lot of hotels because I was there for over a month. And they have eliminated any sort of contact in the guest room. They don't even come into your guest room, and you really have to request something. And so a lot of costs have been taken out, which it will be very interesting to see if costs come back in as we open up, because I think we all know that servicing a guest room was sort of becoming an option for some of those full service hotels or mid-priced hotels. In a luxury hotel, I don't think that would be acceptable, but at some levels, you know, if you don't want to have your hotel serviced, fine, we'll take a little bit off your rate. So it's been interesting.
And Simon, is that something that you've been doing at Hilton? Have you been pulling back on some of the servicing in certain of the rooms? So is it very much, we won't come in unless you want us to?
Yeah, look, I think absolutely from a cleanliness point of view, I mean, clearly with lower occupancies, we've been rotating guests through rooms and cleaning them separately as and when required. It really depends upon the type of business that you've got. I mean, a lot of the business that, you know, we've been taking has been either key worker business, quarantine business, elite sport business, a lot of long-term government contract consultancy businesses. So it really depends where in the world you are. But as we've started to open up and we've got more leisure transient back in, you know, the guests are still, you know, pretty demanding, but I think they're understanding of the situation that we're in. And we've tried to cut, you know, our service levels accordingly. And, you know, we will certainly be, you know, ramping up, you know, our offerings, you know, in the hotels as we get greater and greater occupancy. And but I think we've got an awful lot of efficiency into, you know, into those hotels, and the key for us all is to retain that and to, you know, and to reap the benefits of it.
Thank you very much, Simon. So, Jonathan, we're all absolutely looking forward to hearing from you with your on-the-ground perspective of what's really happening in the United States. You know, where and what kind of hotels are opening up? How is the vaccine program rolling out? What kind of stimulation packages are on offer? Just some general observations and personal thoughts from you would be fantastic.
So that's a lot. I'll try to be brief. In terms of the stimulus packages, there has not been enough. There's not been enough broadly, but what has happened is primarily benefiting hotels. The PPP program administered through the Small Business Administration, and they allowed for a 2.5 times your previous operating expenses. So 2019 operating expenses, 2.5 times your monthly expenses to be advanced in the form of a loan that, assuming you spend it on the right things, payroll, various operating expenses primarily, is forgivable. And then they just did another add-on to that, which is 3.5 times. So what it's done is it's created a significant boost into hotel operators to be able to make payroll, make their property tax payments and other things. On the flip side, what it's done is it's shown lenders that there's some more working capital and more liquidity that operators have, and they're not racing to create loan modifications or restructurings as quickly because they don't need to for X number of months. So that's been extremely helpful. What's very depressing is, and I normally am on planes a lot, flying all over the States. I've been on planes a lot less, but flying 2 weeks ago from New York City to Miami, or from Miami to New York City and then back, the planes were jam-packed. Not a single seat on the plane. There are less flights, but jam-packed. I was in Portland, Oregon, in the Pacific Northwest last week. Same thing, limited number of flights available, but the planes were full each way. In downtown Portland, it was empty. It was really empty. Many of the restaurants are closed. Many of the delis and coffee shops are closed. The hotels, full-service hotels that closed, most of them are just getting ready to reopen or just reopening now in anticipation of spring and summer leisure travel. But there's no business travel whatsoever. There's virtually no group travel whatsoever. I've seen the same thing in downtown Providence and Philadelphia, in Midtown Manhattan. There's there's no business travel. And you can tell based on getting on the planes. Normally I would get on a plane and sit next to a bunch of people or be waiting online next to a bunch of people in suits and briefcases ready to fly somewhere and go straight to a meeting. I'm not seeing that at all now. Now I'm seeing people in running suits and they're in their athletic leisure wear. So
maybe that's just how they dress for business now, Jonathan. Maybe they've changed the way they dress.
I think business transient will start to come back in the States in a few months, but will still be muted. There are a lot of issues in terms of, we have 50 different states, each with its own rules and regulations on testing and quarantines and liability protections for employers putting people on the roads. So if you go to the airport in New York, there are different procedures in place than going to the airport in Los Angeles, Chicago, or Miami.
And what would you say are the key lessons that the rest of the world can take from the States in terms of your recovery trajectory? Is there anything specific that you think would be good for us, for the rest of the world to bear in mind and take through?
I don't think there's that much to learn other than very clear, very specific guidelines for travel programs and parameters. And what we've done wrong and very poorly here in the States is have constantly changing protocols, rules, and regulations done by states, and in some cases by cities within states, which makes it very difficult to book going forward. I'm not sure we've done anything all that great. Our vaccine rollout is a lot slower than it should have been, but it is happening, and and that creates a lot of hope and optimism for leisure travel to really pick up over the summertime with a lot of pent up demand.
And in terms of distress, are you seeing much of that yet?
There is
sales.
A significant amount of operational distress. There is very little in terms of distressed sales and pricing, and for several reasons. Number one, there's a massive amount of liquidity in the capital markets, so very different than what we saw in the end of 2008 and 2009 when there was a liquidity crisis. There's massive amounts of liquidity. We had what feels a lot more like a natural disaster kind of event with a complete cessation in travel, and many businesses and many parts of the economy are extremely healthy, right? Technology companies are going gangbusters, healthcare going gangbusters, right? It's travel, food, restaurants, those are the ones that are getting really hit. Education is kind of a mix all across the board, depending on privately run versus publicly run. So we're seeing very little in terms of distressed transactions. The banking regulators have not forced any of the large commercial banks or regulated banks to clean up their balance sheets with bad loans. There has been a lot of extend and pretend, right? So basically create some deferral, create some short-term loan modification instead of big restructurings. So the only places where we're actually seeing distressed transactions are where generally there were problems on a pre-COVID basis, and there is inability to make operational expense payments, to make payroll, to pay property taxes, to pay property and casualty building insurance. That's where lenders are getting more aggressive, but people were waiting for massive amounts of distressed activity, and it's not happening.
No, thank you, Jonathan. And I think you say extend and pretend. Maybe there's not so much of the pretend this time round. I think everyone seems to know what they're doing. Well, I'm sure we'll touch on that with Tim in a moment, but I'd just like to ask Graham first. Graham, here in the UK in particular, everyone's talking about distress a lot, but we haven't seen much of it yet. Why do you think that is? And when, if at all, do you think that distressed assets will start to shake out into the marketplace in terms of those M&A transactions that Jonathan was talking about?
Yeah, I mean, we're seeing a lot of the same trends here in UK and Europe that Jonathan mentioned there in terms of liquidity and support, where you've got businesses, particularly freehold-backed businesses, then the existing financial stakeholders are providing the necessary liquidity and headroom and accommodation to enable the business to trade through this period of interruption and forced closure, so that they can get through into that phase of reopening. But I think what we are seeing is that through that accommodation, and people have been using government-backed loan structures, and also accruing some other liabilities. Maybe if it's a ground rent deal or a lease deal as well, then those liabilities are building up. I think what we're seeing is that whilst that accommodation is happening to enable businesses to reopen, I think as we start getting through the reopening period into the summer, into the autumn, then I think it'll be interesting to get Tim's views on this as well. But the lenders and, if you like, secured creditors to the businesses, I think will want to be seeing a deleveraging plan from the borrowers, because I think the balance sheets will be stretched coming out of this shutdown period, and whether that's going to be fixed through further equity injections, through subordinated debt, or maybe preferred equity, some form of non-secured instrument, then there will need to be a plan for deleveraging. And I think if that's not coming through, if that's not possible, agreements can't be reached, then it might actually be, once we get into the reopening period into the autumn, when we start to see some of these situations shake out, where frankly the incumbent financial stakeholders can't reach an agreement on how best to delever the structure.
No, thank you, Graham. So Tim, over to you now. Many banks obviously waived the financial covenants and provided additional liquidity lines to owners in Q2 2020 onwards. With the third lockdown here now likely to extend into, well, certainly the end of Q2 this year, many owners are now asking their lenders for further liquidity lines and covenant waivers, we believe. So do you think we'll see increasing pressure on owners from lenders to find new equity or MES, or to sell assets or realise capital?
Yeah, thanks, Karen. I think we're starting to feel more positive about the world right now. I think just anecdotally, when I think about all of the business plans that we reviewed in Q2 last year, none of the downside cases included a potential assumption around the lockdown in 2021. So, what we are seeing now is super challenging. Having said that, certainly in the UK, and from some of my conversations I'm having in the States, so over the last 3 weeks or so, there has been a sense of some pivot to confidence, based on a combination of successive vaccine programs here in UK, and it's certainly ramping up in the States. Budget being relatively supportive, and of course here in the UK the roadmap. And I think we've seen that in terms of investor and owner behaviour literally over the course of the last few weeks. And my sense is they're getting a line of sight now, and they've got some of the confidence from the trading from last year. But that's not to say that businesses aren't super leveraged. They are. And to place it in context, we lent via government schemes alone about 14 billion last year. Now that's not just into hospitality and leisure, that's into wider UK business. But if we've got 20% market share in the UK, it gives you a sense of what is COVID linked lending into UK corporate. So we know the businesses are leveraged. We're equally aware that there will still be cash cliffs that are going to come down the track, as Graham mentioned. But we also are of the view that what
Tim.
What we are seeing now is we're seeing more we're seeing that likely the solution is possibly going to be equity-led, but the clients do generally have a plan B. So they've either got access to equity, they've got an alternative income stream, there's possibly an asset sale, there's a negotiation with other creditors, but there is an angle. Now, that's not to say that there's not distress, because, you know, we do have distress in our book already. Arguably, and to Jonathan's point, some of it was actually pre-COVID anyway. So my sense is that the businesses, that they are leveraged, their ability to access more debt is limited. We sense that it's more around an equity or a preferred equity solution, possibly linked in with one of the plan Bs I was talking about. Plus, of course, we've seen that there is huge liquidity in the marketplace as well to support businesses. And you saw the Apollo participation in Generator, which was announced a week or two as an example of that. So that, aligned with some of the activity that we're seeing on the investor side, is just starting to get us feeling of just that perhaps positivity starting to come in.
I'm going to step in at this point, Tim, because we seem to have lost Karen. Apologies to everybody, and mostly apologies for you having to make do with me as a temporary stand-in. I will do my best. I don't have any access to the questions that she had intended to ask you, but let's continue. What I'll do is throw something open, if I may, to all of you, and if you can give me a signal, whichever one feels you want to jump in, that's fine. I think we've covered the present, we've covered the past. Let's look to the future. And let's look to what specific initiatives you feel the hotel sector should be focused on in order to make itself more attractive to its owners, to its investors, and to the traveling public, who, after all, is what we really need to come back to us. So on the basis that Jan and Ashley are the top of my screen, Jan, do you want to kick us off? What should hoteliers be doing to make hotel investment more attractive to the owners and hotels more attractive to the traveling public?
Well, thanks, Russell. Well, I mean, Kersner ourselves, we own a number of our hotels or have ownership. So, you know, what we're looking at doing, and all hotels should be doing, is, you know, managing your costs as best as possible and looking at maximizing revenues. And I think when we see future bookings ahead, we're seeing robust bookings out into the future. In 2022, we've seen a tremendous interest in bookings, and the rates that are being charged are astronomical. And I think in this, from luxury across the board, we're seeing a lot of hotels that are absolutely increasing rate 20, 30%, because that's what they're seeing during this pandemic. Now, from an owner standpoint, that's great. Let's get as much as we can out of the customer. But I think it also needs to be balanced, because you don't want to create ill will with your customer as well. So you really need to balance what you're going to do, at least at the luxury sector, in the rate category.
Russell, you are on mute.
So I am. How about you?
Well, listen, I mean, yeah, I mean, I think the COVID has changed certain things, which we already touched base upon, you know, cleanliness, lean service model, and etc. But we have about, I mean, Accor on its own has about 40 different brands these days. And when you add the Marriotts and Hiltons and Radissons of these worlds, I think we're doing everything as hoteliers to give an option to customers. So I think everything is available. What we have to stick to, of course, is the sort of the providing the best service, making sure that everything is clean and technology is there. And one thing though, what we, as all of us as a hotelier, need to really start learning I've been in this industry for 27 years, and I get to a stage where our newer customers, especially for our lifestyle brands, that's a whole new generation that are on their sort of mid-20s, I'm struggling to understand their complete desires and what make them choose your particular hotel and services. So I think we, as those who are the executives and leaders and owners of this asset classes, we all need to actually learn from these new generations to be able to maintain a good level of product.
Leslie, I think you're absolutely right. And I think that the young generation very much looks at ethics and sustainability and good for the community. And I think that's very important to focus on.
And how we translate that into everything we do with our buildings that are old and new.
Absolutely.
That's the trick, yeah.
Let me try and bring in
Russell, I'd like to add on to what Jan just said and what Ashley said in addressing younger people and technology. And the hotel industry, as a generalization, has been awfully slow in adopting and embracing new technology. And it's largely a function of a very large universe of different owners, brands, operators, different systems, different operating models. But one of the things that we've seen over the last year is an increased pivot to more digital check-in, mobile check-in, communicating with customers digitally, which is not for everyone, but many, many people today use it and expect it, right? We all travel through airports and we don't spend a long time waiting on a line, to go check in anywhere, right? We're checking in online. We've got our device. We're walking through mechanically because that's not a real high quality touch point or value add. So one of the things that I think this, one of the silver linings, so to speak, of this environment is a much more enhanced focus on technology solutions for customer interaction, for check-in, for kitchen, for food and beverage, for concierge, and being in front of customers.
So I think that all of that is great, but I'm now going to turn to one of the biggest hoteliers on the planet, who looks after one of the most famous brand names on the planet. How is Hilton, Simon, going to set itself apart from all the other hotel companies out there and be really able to, I would say, regain the opportunity that is there for the taking?
Russell, I think there's a number of things at play here. First and foremost, it comes down to culture. And I think if one thing we've learned through this pandemic is the strength of the Hilton culture. And I've certainly never worked for an organization like this, and the extent to which our team members leaned in to support. And I'm sure many other businesses would say that, and I fully respect that. But this really is quite a special organization with a founding vision and a founding sense of purpose that runs very deep throughout the organization. And I think that's where we see our points of differentiation versus the likes of Airbnb and indeed many of our competitors. We are a hospitality business first and foremost. We're in the business of people serving people, and that I think will absolutely come to the fore, and we're going to double down on that very strongly as we move forward. Beyond that, you would expect me to say the strength of our brands. I mean, the one thing again through this crisis, all of our brands are performing incredibly strongly. We're making significant market share gains in all markets, all brands, all segments, all days of the week, pretty much across the board, actually. And I think, there's nothing like a good crisis to sort the wheat from the chaff. And I think ultimately our commercial engine, will come into play. And, that is something that we've had to work on and modify, because if you think that 60% of our occupancy historically came out of our Hilton Honors program, a lot of that was international travel, and international travel's just stopped. And so we've had to go hunting for business in domestic markets. And I think if there's one thing, we're going to come back stronger with local propositions. And in many ways, our business, I think, has got the best of both worlds in as much as we've got a global platform. But, we've got real strength in depth, in understanding domestic markets now, and really doubling down on those domestic markets and focusing a lot of our effort in exploiting that, and actually distributing leadership right the way down to the lower levels of the organization, out in the individual markets. And I think that's going to be quite a sea change for the organization in some respects.
Okay, I've got a couple of questions. I want to come back to you if there is time. We've had a couple of questions in from our distinguished audience, so I'd really like to make sure we do that. But very quickly, either Tim or Graham, do you want to contribute to this and perhaps speak more from what hotel companies should be doing more from an investor's perspective?
I think just from an investor's perspective, what people are interested in at the moment is really finding platforms that are scalable. I think because of the competition in the market, when opportunities do come up, it's a bit of at the moment a race to the bottom in terms of yield, and therefore a race to the top in terms of pricing, because there's so much capital chasing every deal. I think there was, maybe this is the driving force between, Apollo coming into Generator, the ability to actually back a platform with an existing team, which then, offers you something which is different than simply an asset by asset investment appraisal. I think that's something that's certainly called for in the market at the moment.
And Tim, anything quickly to add?
Just in terms of themes, so whether it's staycation and the Blackstone transaction, or as Lee says, extended stay, and also the Blackstone Starwood transaction in the US, these seem to be themes that investors seem to be picking up on, as well as to Graham's point around the ability to scale.
Okay, one of our distinguished audience is a young 27-year-old, and he or she says to ask or answer the millennium generation question. As a younger person, authenticity or a sense of something being unique is a huge feature of why we travel for leisure. How do you address this in a hotel business model? So how do you address this in a hotel business model? Jan, can you really cater to a 27-year-old, or do they need to wait until they're 57 and have got a bit of money behind them? Or
we're happy to cater to anybody who wants to stay in one of our hotels. And while they're not the cheapest hotel, we like to think that what we develop in every hotel is a very authentic experience. And so that starts from the whole development process and creating an area program, a design, architecture, and everything that is authentic. It blends well with the environment, because our resorts are usually put in very interesting locations, and we like to take advantage of that. And so in doing that, we also bring in a lot of the local culture into the hotel by hiring and employing locals and trying to bring in some of their cultures and habits and music and other things that will be part of the hotel experience, as well as food.
Okay, authenticity for you, Simon? I think you're muted.
I'm having trouble with this, actually. I noticed I went off and I came back on, and you were now answering the question. So take it we lost Karen, did we, as well?
We did.
Okay. No, look, I think authenticity it's a big consumer trend out there at the moment. And I mean, specific for millennials, we have products that are targeted directly at that group, like Motto. However, I think ultimately it comes down to personal relationships and understanding your customers and getting an offering out there that is appealing to them. And I think that you can absolutely do that within a hotel environment. I think it's tailor-made for that.
Oh, we lost Russell now.
But this is one of
so I'm now a question master.
Yeah, this is one of the reasons why Zoom technology and audiovisual technology is not going to replace in-person meetings.
Exactly.
It can supplement, it can enhance. There's nothing quite like being in the room at the cocktail reception, You know, even checking in, checking out, walking through, seeing people you know, you know, and all of a sudden you might wish you could mute the person next to you, but oftentimes you can't, and there's that level of interaction.
I think I close more deals in IHIF in one day than I do in a year within the last year, or just doing it Zoom meetings. It's just much difficult. I agree with you, Jonathan.
Absolutely.
Yeah, I don't know.
Third time lucky you get me. So let's see if we can carry on with that one. Sorry, I interrupted you, Jonathan. Carry on.
Yeah, this is almost like a Survivor Island kind of competition. If you ask the wrong question, you get voted off the island, and we're going to see who's left to, you know, get the pot of gold, or you know, or whatnot. But you know, we're living in this very interesting environment where we will see, like, we're relying on decades of experience and thoughts as to how we're going to pivot later this year and next year. The reality is we don't know. What's happened, you know, starting in March last year, really through December or so, is the people that were traveling either were desperate to, or they needed to, for a family reason, for a professional reason, and customers have been very understanding and accommodating of, you know, removing certain services. Certain full service hotels are really full service kind of in name only right now, because their spas closed, the fitness center might be closed or is limited to one at a time, the pool is restricted, the bar is restricted, and yeah, they're doing room service. You know, they might have had closed restaurants that are reopening. You know, at the luxury level, there have been more services, but, you know, that's mostly in smaller properties where they can cater to someone who will pay for that. So we've had a very understanding traveling public. We're going to see how that plays out later this year and into next year, when you see occupancies go in, and instead of being 20% annualized, go to 50 or 60% annualized, if the reduced level of service, you know, is okay by everyone. And it will be fine for some, and for some it will not.
If I can get to a beach, I'll be very forgiving of anything, I can assure you.
And it seems that we've invited Russell back onto the island, so we've forgiven.
I can't believe that, having now done the best part of a dozen of these, we've been beset with computer issues. My computer suddenly decided to go into a restart. I have no idea why. I'm going to try and cover the last few minutes that we have. Two quick questions. One for, I suppose, Simon in a way, but I'd also like to hear the views of the rest of the panel, which is posed by a member of the audience and goes along the lines of, should there be any long-term changes in the structure of management contracts and or franchise contracts, in terms of whether the fees are more variable, whether the terms and conditions are more owner-friendly, and so forth. So maybe, Simon, if you want to kick off with that, and then if Jonathan and Graham and any of the others want to chip in, that would be great.
Yeah, listen, Russell, I think, you know, management contracts, franchise agreements have, you know, have pretty much evolved over my 15 years in the industry, and I think they will continue to evolve. And I think, you know, there is you know, a balance to be struck between the risk and reward. And, you know, most of our management contracts and franchise agreements now are specifically designed to align owner and operator interests. And, you know, I feel they're getting closer and closer in that regard. So I think that that trend will likely continue.
How about you, Jonathan?
Yeah, so
what are you seeing in the States?
Yeah, we're already seeing it. There are modest changes that we're seeing in mostly in management agreements, because the reality is the majority of the franchise agreements, the fees that are paid are mostly tied to rooms revenue. So if there's less room revenue, there's less fees paid. There are some that are fixed costs, and the brands have been incredibly good in terms of working with owners in terms of reducing costs. The modest changes that we're seeing really relate to an unintended, shutdown of a hotel or a management company working, for a year or a year and a half with virtually no compensation, even though they're working incredibly hard to keep things afloat and do things. So we're seeing amendments to management agreements and new ones that, in the event of a severe downside case or a force majeure event, have a minimum monthly fee, so that the manager or franchisor is not getting rich off it, but they're actually, coming close to covering their own cost, which I think is a good thing. I think no one wants their operator to be scrambling and worried about, running their own business when they're worried about the operations of their hotels. We're starting to see more language come in about who has authority over closing or reopening hotels, which was kind of a big issue as between operators, franchisors, lenders, and investors in the States, when we had to come to decisions of, do we shut down tomorrow? Do we shut down on 24 hours or 48 hours notice? And what do we do? And do we need lender approval? Do we need the brand approval, the manager approval? How does it all work? So, really not a lot of wholesale changes at all, but some tweaks to adjust for our recent learning lessons.
And just before I go to the final question, anybody else from the panel got something to add to that particular point? So let me challenge each. Say again?
I thought Simon summed it up well. That
he did. He did. He's a good summer. Good summer. That's what we all want, is a good summer.
You asked me to be short, Russell. Short and sweet.
Brief, that's the word. Ladies and gentlemen, we've reached the time in our schedule when I need to ask the final question. I've no idea what Karen was going to ask, but let me ask you. Your fairy godmother has suddenly granted you 100 million, either euros, pounds, or dollars, and you are looking to invest that before the end of 2021 somewhere in the hotel industry, somewhere in the world. Okay, so in a very short sentence, where in the world, what type of hotel or hotels, and is it going to be a great investment, because it's probably going to come out of your pocket at the end of the day? So Jan, where in the world and what in the world?
Well, I would go to a few locations in the world that are very popular resort destinations, like Napa Valley, like Lake Tahoe, like Hawaii, and I would build luxury hotels with branded residences where the market price for residential property is off the charts. It'd be a great investment.
Good stuff. Graham?
I'll buy something in Venice, because this will be about the first time in the world that Venice is almost empty and you could actually wander around and enjoy it without 2 million people standing on top of you.
You possibly still will need your Wellingtons. Jonathan?
So you might have figured this out from some of our other dealings, but I would be investing in and upgrading a 5-star hotel in Jerusalem. I think it's under-hoteled at the luxury level. I think with the Abrahamic Accords and all of the peace treaties between Israel, the UAE, Bahrain, Morocco, etc., there will be massive amounts of tourism and visitation, including a bunch at the ultra-luxury level. And the state of Israel currently doesn't have much in terms of offering in that super luxury level.
Wonderful. Tim?
I must confess, Russell, I've spent the last 12 months not necessarily looking outside towards investment in exotic places and amazing hotel concepts.
Well, the East End of London may be exotic to some, so don't worry about having to choose a location.
Just the let's just say the UK coast, with the benefits of its global warming and an established leisure building demand. I'll go with that.
Okay.
Closer to home, not quite so exotic.
Ashley?
I probably will spend all that money for this summer's and next autumn's bank-forced sales on the mid-scale and extended stay. Well, you won't have the extended stay, but mid-scale properties that are all going to be below construction costs across UK and Europe.
And you'll turn them into extended stay properties, will you?
Exactly.
Knock two rooms into one. Okay.
Exactly.
And Simon.
Oh, listen, I don't think you can beat the Hampton model in the Americas, actually. So I'd probably invest in focused service in the Americas. But actually, interestingly, maybe a slightly longer shot. If I could crack the Indian market with a focused service operation and crack the culture and the rules of engagement, I'd be very happy to do that as well.
Well, thank you all our panelists. I'm sure those watching will have been as perturbed as some of us were at the ability of technology to get in the way of making this work. And I apologize to anybody who feels that they have been inconvenienced in this process, most particularly to Karen, who did a great job in preparing for this, but sadly wasn't able to complete the execution. So please join me in thanking Jan Hazelton, Graham Smith, Jonathan Phallic, Tim Helliwell, Ashley Cutlican, and Simon Vincent for providing a very, very entertaining panel, a very informative panel. And whilst on the subject of thanks, can I also thank David Eisen for joining us with his presentation, and someone called Russell Kett, who did a fantastic job. But we learned at the very beginning of this whole journey that most of you out there felt that RevPAR will recover in 2024, and thankfully nobody felt that it will never recover to the 2019 levels. It's good to also note that the fastest recovery is felt to be coming from the Asia Pacific region, that transaction volumes are going to be fastest recovering in the North America and perhaps followed by continental Europe, and 80% of you want a green passport. And I'm going to end on that and to say I hope very much that the vaccination process and that life in general will mean that we can all travel with a lot more comfort, a lot more hope, and a lot more safety into the future. I wish everybody a very good Easter, a very good Passover, a very good summer to come. And I hope that you will all join us for our next collaborative venture on this topic of hotels and hotel investment, which will be coming to you on the 11th of May. Look out for that. We'll look forward to presenting to you again in the future. But for now, handing over to Lauren to close us down and to send us on our way. Thank you so much and enjoy the rest of your day.
Thanks, Russell.
Thank you to all the panelists as well. And absolutely, we will be sending this recording out as well as the slides that were used. So please, looking forward to seeing you on the next one. Thank you again. Bye-bye.